initially I thought 2025 would be an easy layup. And well, big question, when will the deteriorating fundamental conditions bring the stock market down? It is more likely to occur later in the decade than in 2025, usually in years ending in 7 or 0. I'm a big believer in the decennial pattern of Edgar Lawrence Smith. And I'll put this all together as we go through here. There's too much money lifting all asset classes. In order to monitor this, I look at the auction markets. I look at the steak dinner that we had in the spring in New York in the Lower East Village for $315. Parking the car was $50. I remember when it was $5. Then there was the 54-year cycle. That's 3 18-year cycles. It will be explained some other time. Every third one is the most important. So 3 times 18 is 54. For example, Russia took the Crimea 161 years after the Crimean War. So that's 3 times 52 minus 1 year is 161. So this works in history and society. And so I look at it to get some idea of what fundamental conditions might be. So if we go to 2025 and we deduct 54, we come to 1971, which is when the Fillmore East closed, the psychedelic era ended, the disco era started, and there was inflation, social unrest, rising interest rates, a declining stock market, and rising commodity markets. If you missed the 70s, you were lucky, because the stock market at best, well, it went from 1,000, I think, in the late 60s to about 500 in December 74. I'm driving along and I saw a sign that said survive in 75. The market bottomed then, by the way. So not only did the market go down, but there was price inflation and you had a real destruction of wealth. The money you got back out of the stock market did not have the purchasing power. So you can already see pieces of that right now with the rising rates and commodity prices lifting, etc. So auctions tell us there is too much money. This is the banana that sold, I think, for $1 million, and the guy took it off the wall and then ate it. That's excessive, but I have further excesses here. $1 million shoes up for sale. The Wizard of Oz, Judy Garland's ruby slippers are up for auction. And my favorite, baseball star Juan Soto did not renew his contract with the New York Yankees. He signed with a 15-year contract with the New York Mets for $765 million. That is $51 million per year, $315,000 per game, about $90,000 per at bat, and about $131,000 per hit. If you have been a fan for a long time, you might recall when Mickey Mantle and Willie Mays became the first 2 players to break the $100,000 annual salary barrier. If this is not excess, I don't know what is. This guy, Juan Soto, gets $90,000 per at bat, and Mickey and Willie got $100,000 for an entire year, which is about 500 to 600 at bats. So bubbles usually do not occur in years ending in 5, where they do not burst, I should say. And the fundamental cause, and I think most people miss this, I listen to people in the media all the time. On August 15th, 1971, Nixon closed the gold window. On March 31, 1980, Carter signed the Monetary Control Act, which, if you understand it, it says that the Fed can monetize anything. It can buy all of our American Express card debt and put it on their balance sheets as an asset and then issue credit against that. And if you think that makes sense, then you should probably join the Fed, I guess. This enabled the Fed to monetize any paper. So the debt of some foreign country was only worth 10 cents on the dollar, they would buy it from them on a dollar basis, sit on it as though it were worth 10 times what it's worth. They didn't mark it down to market value. They kept it on their books. So this is the Fed assets have gone straight up. They've inflated the currency tremendously. So there's few limits on what can be monetized. If there's no limit on what can be monetized, that $350 steak when I get back to New York might be $600. There is no limit to price increases, so why shouldn't the stock market go up? So my original forecast was originally for a Q4 rally into a January top, which is turning out to be a bottom. The weak December altered this view. It is very rare for December to be down. It's up about 72% of the time. A rally is now expected from mid-month, right now, it began yesterday or Tuesday, into February, followed by, I think, maybe a little decline into March. 2025 is expected to close up about 10% in a volatile year. And I think the reasons for the volatility are we don't know what the new president is going to do. He's obviously going to have policies that are very different from the prior president. I think that will cause a great deal of volatility. And you've got a lot of people out there who are accustomed to the market going up 20% 2 years in a row. And I think they're going to have a much tougher time this year, which is why I said I think there'll be a greater need for market timing in 2025 than there were in the previous 2 years. So here's the S&P 500. This blue is a rectangle, as you know. You might not know that the Financial Analyst Journal actually had an article by PhDs that wrote a fuzzy logic program that detects different technical formations. The rectangle was the single most numerous formation. Rectangular lows were the most profitable, much more than rectangular highs. So this blue rectangle, according to the PhDs, is very reliable. And using cycles, I predicted it would break out. And if it breaks out, the blue line, you project that height of the rectangle up and you get 6,100. The market, the S&P touched 6,100 and immediately came down. But there's a big green rectangle, or you could draw it in another way and make it a symmetrical triangle. I prefer to call it a rectangle. That counts to 6,300, 6,400. So right now, this is not updated for today, obviously, but right now we are about here. So this is the 10 days advances less declines. You can see how oversold it has been. This is one of my primary short-term indicators. Now, here is a short-term view with a monthly cycle, which is not updated, obviously, because otherwise the S&P would be up here. Now, you can see why I was expecting a mid-month low. Here is a blow-up of it, which extends out further through 2025. And you can see, according to this, the rally should carry up into May. And by the way, it is the turning points that are important. The magnitude doesn't mean this market's going to go to the moon. And this decline doesn't mean that it's going to crash. It means there's a high likelihood of the market turning down here in July and of us having a July-August correction. And then a rocky Q4. And this is calling for a weak close to the year, which I would dispute, but we'll look further. Now, here's the NASDAQ monthly, and notice it bottomed at the same time the S&P was bottoming, so this is confirmation. Now, this is all post-election years in the Dow Jones Industrial Average from 1885. They've been 34, January up, February down. If you go to Arthur Merrill's book, Behavior of Prices on Wall Street, which was first issued in the late 60s, then I think updated in 84, Februaries in post-election years have been the weakest of all of the 48 months in this 48-month cycle. So that's why I think we would at least see a pullback in this current rally beginning probably no later than the 10th or 15th of March, of February, I mean. Then we get a rally up with a strong, we usually do get a strong April. It's the second strongest month next to January. Then another sell-off. June is usually weak. But I think the interesting thing is it shows a flat August and a weak September and October. And here you see a fourth quarter rally. But it's also, we must take into account the decennial pattern. This is all years ending in 5 in the Dow Jones from 1885. Again, this is expected return. So in other words, if there's a 50% chance of a 3.5% rally, then we get 1.75 on this axis. And as you can see, there's not a negative year anywhere on this graph because years in 5 are the most bullish. Some of them, one of them was down about 50 basis points, I think. Some have been very weak. Some have been very strong. There are only 13 of them. So years after the election have tended to be the weakest in that 4-year cycle. Years ending in 5 have tended to be the strongest in the decennial cycle, which sets up a bit of a conflict. Here's the histogram of monthly expected return, combining both the years ending in 5 that have also been post-election years. So here you get an up January, an up somewhat February, and a down March, then a rally up into May, again a weak June. So I've got 2 counts on a weak June, and then a strong remainder of the year. There have only been 6 of these. So we're looking at the cycles from all different angles and coming up with what Stan Weinstein used to call the weight of the evidence. So let me see. I think it's the slide should be up here. It's further down, but there have been 6 times when these cycles have conflicted. In other words, we had a post-election year and a year ending in 5. In 5 of the 6, the market was up in the year ending in 5. So the year ending in 5 effect completely overwhelmed or absorbed or mitigated the effect of the post-election year. So we can forget about that conflict, years ending in 5 when. But I have some modifiers, 3 of them. After 2 consecutive years of 20% gains, the S&P usually returns 10%. The big exception is 95, 96, 97, 98. We're all up 20%. And then there's the 54-year cycle, which I already mentioned, which that was during a weak market. And here is how the third one, how the 3 indices reacted in the next year after an up or down December. Dow Jones from 1885, if December is up, then the next year is up 61% of the time. But if it's down, it's 55%. If the S&P from 1928, if December is up, the S&P is up 66% of the time, but if it is down in December, it's 52%. And the NASDAQ comp, we only have data from 1980. December is up. If December is up, then the subsequent year is up 68% of the time. But if December is down, then that number falls from 68 down to 59. So these are 3 modifiers which suggest not that we won't have an up market in the year ending in 5, but that we would have reduced returns. Now, we can't leave out the 1-4 10-year cycle. I did that in histogram form, but let's look at the waves. And I think, as you know by now, that red is the 1-year cycle, which is the average cycle of the year. And the Financial Analyst Journal actually tested this, and they call it seasonal attention disorder, or SAD, which is the name of the paper. And they simply acknowledge that it exists. They don't know why the seasonality exists, and they don't know why we usually get this sell-off in September and why most lows occur in October. So that is the 1-year cycle. And the blue is the 4-year cycle, which is known as the presidential election cycle. But as the late Ian Notley used to point out, the presidential cycle, that 4-year cycle, existed prior to the establishment of the Federal Reserve in 1913. It exists in countries where there's a 4-year election cycle, a 6-year election cycle, or no elections whatsoever. In other words, there's a 4-year cycle. And of course, the green one is the decennial pattern. And of course, it's a year ending in 5, so no surprise that that green line goes up most of the year. So if we add them all together, we get this blue line down here. This would suggest we did not have a strong first half of January, but it does suggest a bit of a trading range. And here again, you notice how we get this little high in February, it declined into March over here, and then the strength returns in April, and then we sell off again. You see why I think we might need market timing more than ever. Then a June low, September high. And by the way, the old DOS program, the first one I ever worked on, we had a facility where you could issue a command and leave out 1929, because if you leave out 1929, this doesn't look like an Austrian ski slope here. It looks much more tame. I mean, a 90% decline will do a real number on the numbers, if you know what I mean. So this is the 1-4 10-year cycle in Q1 only. So again, you see this low, that looks like the low from the prior dynamic cycles. Those blue lines you saw earlier, those are dynamic cycles and those were black lines, which means they were drawn from the most recent data by my program. These are static cycles, and that the 1, 4, 10-year cycles hardly change. So we have confirmation. So we have confirmation now of a rally probably up until February, and then some sort of a correction and a low somewhere in March. So this slide, which should have been up further, 2025 sets up a conflict. Years after the election have been the weakest in the 4-year election cycle, but years ending in 5 have been the strongest in the decennial cycle. There have been 6 such conflicting years since 1885. 5 of 6 have closed substantially higher. 1 was down slightly. The average was a 33% gain. I don't think, due to the modifiers, I don't think we're going to get that this year. And here is the little study that I did just for your perusal. The election year is 1904, year ending 1905, 1924, 25, 44, 45, 64, and on down. And you can see the percentage changes over here in the right column. So again, the bullish effect of the 5-year dominates, so I remain bullish from this perspective. Now, one change I do expect, and after the roaring first half of last year, I said technology cannot keep going up at this rate. NVIDIA, I said, will be up in the second half, but not as much as it was up in the first half. Therefore, if the market is going to continue to go higher, it's either going to be other technology stocks that are going to rally, or it's going to be other sectors are going to come to life. And that proved to be correct. But as we get into this year, I think healthcare, that sector is very weak. I don't know if it is going to recover very much this year. Base materials, we're in an inflationary environment, maybe, but these are the strongest stocks from my software on 2 bases, relative strength, which is very important, and seasonality. So number 2 is Citigroup, which I already bought, and they reported earnings yesterday and jumped about 6 or 7%. This is JP Morgan. That is Co-America. Is it Co-America Financial? COF, I forget exactly what that is, but BAC we know is Bank America. Now here's Triple M. Now here we come to our first technology stock, but it's old iron. It's IBM. Then we have Morgan Stanley, Metropolitan Life, a U.S. Bank Corp. Now we come to Apple, Texas Instruments. Actually, Walgreens is showing enough strength to make it. It looks like this. If you like risk, you can bet on a Walgreens turnaround, according to this. Then there's AT&T, Medtronic, American Express, GE, First Energy stock, Occidental Petroleum, Caterpillar. Wait a minute. WFC is, I think that is Wells Fargo. And then now look where NVIDIA is. NVIDIA was number 1. So financial stocks are the emerging replacements for the technology stocks that are not keeping up with the market. And my favorite out of this group is Citigroup, which I said is we already bought, or I already bought. There's no we. And here you can see other financial stocks that are very strong. Now, this is last July. The stocks that I recommended long were up about 6%. Short, they were down. The group was down 1.26%, which are not spectacular numbers, but they went in the right directions. And this product is for a long-short equity fund. My favorite, in which I made the most money last year, is Grindr, which is the dating website for the LGBTQ plus community. Don't want to leave anybody out. Then, of course, there was Google, Goldman Sachs, Oracle, HPQ is Hewlett. What do they call it now? Hewlett Compaq. And Apple, Costco, Qualcomm, the down stocks, Autodesk, Walgreens Boots, Ford, and Uber. So stocks right now, what came up number 1 on my list was Citigroup, which is why I bought it. Number 2, Carnival Cruise Lines. Number 3, Triple M, which seems to go up no matter what happens. I guess people use those stick-it notes no matter what the economic climate is. LUMN is Illumina, I think. And LUV, of course, is the airline, Southwest Airline. Nordson, which I'm short, Adobe, that is, I think, Equifax, and ALK is Alaska Airlines. They report next week. And when there are a lot of very short-term cycles on a daily basis turning down, or maybe even weekly, during the earnings reporting time, that usually sets up an earnings disappointment. Now, the earnings don't have to disappoint. The cycles tell us people are going to sell the stock no matter what the earnings are. We've all seen cases where the earnings were up, were met expectations, and of course, the commentator in the media will say, well, I guess investors were looking for something better. So I think that is the case with Alaska Airlines. Other than that, I'm bullish on the airlines. Now, this is the value of cycles if you're a fund manager. I pointed this out, I don't know, it was around September that I saw this cycle peak right here. And so I had said there's another cycle peak you can't see back here in June. That's one of the reasons I thought NVIDIA would be weak in the second half of the year. And you can see very little progress has been made from November through to the current time. And actually, it is a bit down. And you can see the buy signal failed. Well, if a buy signal fails and the sell signals succeed, here you had, well, that one didn't quite succeed either. But if the buy signals are failing and you're coming to a cycle peak, that is a bearish sign. Now, added to that was one of my favorite tools, namely contrary opinion. And here was the contrary opinion. This is November 18th, 2024. Being on the cover of Barron's is not bullish. As I pointed out in one of the last presentations I did with the foundation, Kamala Harris was on the cover of Time and the cover of Barron's. Now, that's not two strikes against you, that's three. Because, according to the research of Paul McRae Montgomery, if a financial story, for example, appears on the cover of People magazine or Ladies Home Journal, those are not financial publications. That means the trend is so strongly developed that it's pressing right through the financial media into the regular media. Well, the winner of the election, it's a political event. And what is it doing on the cover of Barron's? It's a financial publication. So that was very bearish for the vice president. And here we have NVIDIA, November 18th, 2024, and that was the date of the publication. So you had a combination of the cycle, which is it's really a cycle of buying and selling. And as I always say to people, and this is a point you could never get across, we don't own the companies. I used to say this at Audio, we own the share price. And the share price means everyone else has got to agree with us. If they disagree for whatever reason, we're buying against their selling, the relative strength turns down and we're swimming upstream, we're walking up the down escalator, and we're eating soup with a fork. So relative strength is exceptionally important. And these cycle lines in stocks, to me, are just, it's like people like, let's say, from here to here, people like vanilla, and from here to here, people like chocolate. It's just the mood toward the prices of the stocks. And they shift and change, and we try to capture it with these cycles. So now let's shift over to the bond market. And as I've said several times, I think bonds are headed into a big bear market because I was around in the 70s. And I got out of school in 1972 with my BS and MBA. And it was like there was an old comedy record album called Everything You Know Is Wrong. And I got out with these 2 degrees and nothing I had been taught worked. And I ran into guys who were trading the market and making a ton of money. I ran into Joe Granville, Bob Prechter, Frankie Joe, one of the greatest traders in the history of Wall Street, 60s through 83. And they did none of the stuff that I was taught. And I watched interest rates go up and up and up and up and up and up. And they finally peaked, what was it, 1980? And started to go down. And none of the commentary was correct. So this is 42 years worth of U.S. 10-year note prices. And where are we right now? Well, we're headed into the most bearish month. January's up, February's flat, March is down. But bonds are down already. And so that's the static cycle. And the static cycle doesn't change very much. Let's look at the dynamic cycle. Is that confirmation? It's got notes going down all year. So so between now and late March, I would not even expect a rally, or maybe even into April. Now, let's look at the oil seasonality. Here we're in the reverse situation. There's January, February, March, April, and May. So this is a there's very little, this is the Bermuda Triangle for oil. There's very few setups. I mean, um, Jake talks about setups and the preconditions. I haven't found too much that will save oil in October and November. They're down a very um, most of the time in that time period. And if you can see the bottom of the screen here from, oh, this is rather, can I get this out of the way? Um, oops, now I'm loading apps. Yeah, we can move this up here. From February 12th to May 21, price has risen 63% of the time. From March 20th to May 21, the percentage rises to 75%, 75.6%. Now, the exchanges do not send out engraved invitations to buy, but if they did, this is what it would look like. So one thing you don't want to do here is be short oil except for short time periods. And that's the reason we're starting to get some lift in the energy stocks. I think Schlumberger will report good earnings. I think it's after the right now or it's tomorrow morning. So it's time to start looking at energy stocks. Did they rally in the 70s? Oh, they rallied. And in fact, I was at the Value Line Investment Survey in the 70s, and the poor guy who covered oil, he kept saying, you call me every time for stock of the week. Now, let me explain. They wanted a big write-up once a week, stock of the week. The analysts called it the shock of the week. Nobody wanted to do the extra work. And this guy named Sam, he was the energy analyst, and they kept calling on him. He said, you called on me last week and 3 out of the last 4. And I said, but Sam, energy stocks are the only thing going up, energy and gas. And actually, to give you a little side story, the Value Line stocks are ranked 1 for the strongest, 5 for the weakest. And they go to the top 100 and they pick the stock of the week. So at that time, analysts had the ability, if you put a sell on it, your stock ranked number 1 dropped to a 2. If it was ranked 2 and you put a buy on it, it rose to a 1. So not wanting the stock of the week, everybody would hang sell signals on the 1 ranked stocks to reduce them to 2 so they didn't get the shock of the week. So the internal workings of Value Line. So that is how the energy market looks. And this is, I haven't updated this from last time, but because the computer that does this was just repaired, the guy left 10 minutes before I started speaking. So price is about here, but look at this. This isn't even overbought yet. Quarterly oil from 1880, and that was called back here. Ian Notley had this data, the wellhead price of oil, and it's been kept on, I think, an annual basis since 1880 from the oil fields in Pennsylvania. Now, here's the monthly oil from 1880. It looks a bit different with a lot of Fibonacci retracements. Again, I couldn't update this either, but right now we're up about here. So we're sort of at the, we're at a 50% retracement level. I don't think that 23.6 means anything anymore. As I said, I was unable to change the chart due to the lack of availability of the PC that does that. But you can see we're really in mid-range. You can't say we're very overbought. You can't say we'll probably never be down here again. And now let's shift over to gold. Now, gold, as you can see, let's look at the, oh, I don't think I have the static cycle in here, but maybe we do. That is the cycle. And this down here, I decided to put this little box in here. The strongest cycle that my software picks up is 81 days. Second is 120, then 63, then 86.4. And Richard Mogi used to tell me, we'll take these two, 81 and 86, and combine them. And then we have 109. Those cycles are swinging up right now. That is one reason I'm long gold. Let's look at the technicals for confirmation. Gold's to $3,100. Why is that? Again, we have what? The most reliable formation the rectangle, and we know it's reliable because the Financial Analyst Journal told us that. And prices should rise after they break out of the rectangle by the height of the rectangle, which would put us at 3,100. Now, this has been confirmed very recently. How is that? Here's a breakout from a triangle. See the big triangle? You break out here. You take the height of this triangle, add it on to the point of breakout, and again, you get $3,100. The only question is, when will it get there? And where are we right now? We're in a very strong month. That's the expected return of gold over 42 years in the month of January. You see, February is flat. March is the single most bearish, is the probably you could say the only bearish month for gold. And then you have a rise from March up until August. And actually, August and September have typically been, in most recent years, September has been much stronger than this. It was weak years ago. But as most people know, if you get an up June, you're probably in a bull market, and it just continues on up into August. If you are in a bearish market, then June is usually a low, and then you get this rally into August. So we might get some sell-off here in February, March, but basically, I think this cycle dominates, and these two charts confirm the breakout to the upside. And why not? It's a reaction to all the inflating that's going on. Juan Soto's baseball salary, $1 million for the ruby red slippers, and what was that, $1 million banana? And I have a whole. I watch these auctions, and I keep track of all of this stuff as a measure of the froth, which is something that I learned in the 70s when the price of everything, it was like a snake snaking through all asset classes, sending them all up much higher. And this is from the July 2024 presentation. The situation is like that of the 1970s, in which rates went well over double digits, equity markets fell, and the economy suffered. Investors sold stocks for less than they paid, and the purchasing power of the remaining funds declined. This was a period of very real wealth destruction. Real estate went into a recession as forecasted by the 18-year real estate cycle, which is again at its high. This trend is likely to continue. So let's just go. This is my latest scan of the relative strength of the sectors. I think this is probably going to stay this way most of the year. Remember, I said that the financial sector, the stocks were coming up. It's not a stock market, it's a market of stocks. So if the financial sector is strong, is it a surprise to see financial stocks coming up at the top of the screens? No. Consumer discretionary, number one. Telecom sector, of which I know little, and in communication services, these two are probably duplicative and one should probably be eliminated. Then there's the S&P 500 benchmark. Then we have the industrials. I would expect that to strengthen a bit, but I expect utilities to decline because I expect rates to go up. Energy sector was bottom ranked a couple of weeks ago. It was down here where materials are. Now look where it is. And technology, as I said, valuations are restricting technology. Trees don't grow to the moon. And yes, NVIDIA has great problems. And NVIDIA has great products, I meant to say. And when I published that contrary opinion piece from Barron's and the cycle, some fund manager disagreed with me on LinkedIn. And then afterwards he said, well, as I was saying, it's a measure of psychology. It's not saying that Tesla's earnings and prospects are not great. It's saying investors have enough Tesla, and you've got to give them much more than what Tesla produced in order to get them to bid the price up any further. So then we have healthcare, which I don't think is going to recover very much. Consumer staples, which include the food group that I used to cover. Periods of rising commodity prices are very tough on food stocks, which are consumer staples, because they can't pass the price increases along fast enough to maintain their profit margins. Now, I followed the food sector for Value Line in the 70s, and it was like being the loneliest analyst on Wall Street. Nobody was interested in food stocks. And so the phone never rang. And in 1980, now Smith Barney used to have these great chart books that went back to the end of World War II. And it showed the food group in a big 25-year rectangle. It broke out of that rectangle. And in 81, I was with Alan Shaw and the guys at Smith Barney, and they said, hey, what's going on in the food industry? Are people eating more? And I said, no, why do you ask? because the food group broke out of that reliable 25-year triangle and went on a relative strength tear for 13 years. Usually, you take the amount of time it's been in the rectangle, multiply it by 0.618, which was W.D. Gann's area code, and you get the length of the next move. So real estate, I don't think real estate will recover very much. And in a inflationary environment, materials should at least rise up off the bottom. So that is my presentation. Are there any questions?
Absolutely, Bill. We have questions, and following a great presentation. And I was just saying just now, wonderful blast from the past insights from yourself, but then also industry peers. I heard you mention Alan Shaw. If we could just spotlight that,
Sure.
just for those who aren't aware, those days when it was Smith Barney and Merrill that were basically watching the flows and managing the TA teams. It was great to capture that if possible.
Yeah, well, I worked at Payne Weber, and if I walked one block north on 6th Avenue, I was at Smith Barney. And they had what's called a war room. There were three in New York. There was one at Smith Barney. There was one under Bob Farrell's direction at Merrill Lynch, where Bob Prechter worked, which is where I met Bob. And then there was one at, the name was just in my mind and it popped out, Kidder Peabody, under the direction of Ralph Acampora. And it was in a bank vault. It was an old bank building, and you walked through the vault into, like you did like a Goldfinger. You walked in and there were all the charts. But Smith Barney's, they maintained, they had the Chinese gang came in around 5 o'clock and they updated all the point and figure charts. They had these huge books and they opened them up and all these guys are putting in the X's and the O's.
And
And
this
then
is
they had
hand
it.
drawn.
Yeah, it's Smith Barney. Yeah.
Hand drawn, no computers.
Oh, yeah, that's right. And they had on the wall a hand drawn, it was a daily chart of the Dow that started like on a wall and then went 25 or 30 feet that had been kept up. And my friend Bob Colby, whom I work with at Valley Line, he went to Indicator Digest and then he was hired by Alan Shaw. That's how I got to know Alan. And so I used to go up there. And of course, it was like going from the minor leagues to the major leagues, from Payne Weber, which their technical analysis department consisted of Jim McCarthy and myself and all the charts we could draw by hand.
Wow.
And I used to have a home computer. I used to run stuff off on an old Taitung 286 computer with a line printer, and I used to bring it into work in the morning. And that's how primitive it was. And of course, I'm trying to think of the names now. I forget I can see the faces, but of course, there were three great war rooms. And of course, Alan Shaw was, first of all, very well spoken, very confident, and like my old pal Ian Notley, very relaxed. No matter how volatile the market got, he would get you to calm down.
He once shared a humorous note at a US conference, which
Yes.
I managed to meet him in. And he said he was one of the very few technicians that had his brain examined, quite literally, but he was playing on the metaphor. And in recent times, he passed away, but of course, his lifelong heritage continues also in many of the proteges that continue. I believe Luis Yamada is one, and Ralph Ackenper, of course, worked closely with him. And one of my early mentors, David Fuller, did too before he relocated to the UK.
Uh-huh.
So it's a memory lane, and certainly how it used to be done back in the day. You were talking about chart rooms and war rooms. Fidelity had a chart
Oh, yeah.
room
I've been in that
from
one, sure.
way back when, right?
Yep.
Since the 70s at least.
Yeah, that was that Bill Copeland and I can't remember who, Doug Erlanger, Phil Erlanger.
And so some of the questions we're getting from the audience, Bill, I mean, the first one is perhaps a recap on, well, your cycle framework and specifically reference to the presidential election pattern 1 week away from inauguration, Jan 20. So it's top of mind. The question is, could we recap what your work on presidential election patterns suggests this time around? You did already share that, but if we could recap. But then also, are there nuances with certain leaders and policy impacts, such as Trump 2.0, in your view?
Well, this year's a bit of a mystery. First of all, I thought the market was going to run straight up into January 15th, correct a little bit in Q1, and we would get another 20% year. And of course, December changed that. And if you start looking at it, like I think we all like to make social comparisons. And 1970, 71, the fade out of the psychedelic era and the start of the disco era makes me think of Jimmy Carter and the Democrats being in charge. And then the subsequent period was Ronald Reagan, that was much more conservative. But now we seem to have a very conservative president, a strong president, going into sort of like walking into the swamp, like mud up to his knees. The debt levels are much higher. I think the country is solidly behind him, but I just think the problems are a little more insurmountable. It's not going to be as, the first thing they did, of course, 80, 82, they rang the inflation out of the system. But as my friend in Parliament in England once said, I've never seen any politician elected on the policy of deflation, which is what is needed. And so I think you're going to get an unusual mishmash. These periods are never the same. In the 70s, I followed the forest products companies, and the fund manager calls me up and says, well, what do you think about Willamette or Boise Cascade? And I said, well, I think the earnings. No, no, no. He said, I don't want to know the earnings. I want to know what the acreage that they own is worth. Like, how much is it worth per acre? Diamond International traded at 40. The land that they owned was $80 a share. They took themselves private at 100. In other words, the asset value was so great, nobody cared about the earnings. That did not happen with forest products this time around. Hasn't happened yet. Diamond stocks, same thing. Copper, this is all changed. So I don't think, the 70s was not a great time for technology. That was mostly commodities. So I think you'll see more commodities. I sort of agree with Andy and Jake from yesterday. So more commodity-based stocks have probably go up. And so if they go up, that's very bearish for foods. I was following foods in the 70s. They did very poorly. So it's an unusual mishmash of sort of Ronald Reagan and Carter Democratic years. And I think that I don't think there'll be very much warfare. One reason is Donald Trump is right when he talks about lethality. My old pal Jim Dunnigan, now some of you will remember this, Strategy and Tactics Magazine, Simulations Publications Incorporated. We used to play war games with little pieces and roll dice in the 60s into the 70s. Well, Jim was known as the father of modern gaming. And I worked there when I was a student. And so I just got his recent note. I didn't know this. It took 18 shots to kill a tank in World War II. Today, it takes one. So this raises, look what just happened to Russia. And look what happened to the North Koreans who got thrown into the front. Can anybody afford to fight a war? And I used to get into disputes because in Abu Dhabi, we have a lot of military men, a lot of CIA and um, guys from who knows where, but arms dealers. I got into I used to start discussions. I said, is warfare more likely or less likely in the future if you can send up drones? There's no loss of human life. I mean, look at what the Ukrainian drones are doing to the Russian soldiers. And so I was making the argument, well, if you could build, Star Wars, was it the Clone Wars? If you can build machines that fight each other, it seems that he who has the greatest industrial capacity and the most money is going to win, which sort of makes the whole thing sort of unnecessary. It's just a lot of, you get a lot of burnout junk, which is these games I see kids playing in the war game stores. So I think war is less likely because I think Trump is right. He said the lethality is so great that I don't know if anybody wants to fight a war, will fight a war. And I pointed out to Jim Dunnigan in New York, I said, do you remember World War One started out with spotter planes? Then they carried 45s. And they started to shoot at each other. Then they carried bombs and they started to throw bombs down on people. Well, how did we start with drones? Drones were used for spotting. Then they were equipped. Now we have the, I forget the names now, the Reaper and I forget the name of the other one. But these things can do stuff that fighters can't do. They can move at such speeds that it would literally break the pilot's neck. They can come down and swoop very low over the ground. Well, a human pilot could do that, but apparently a drone can't. But the drone can make changes that would just be too destructive to the human body. It can move that quickly. So I'm saying if you fill the air with these things and they've got no pilots, then, on one hand, you might say the guys who have the less machines are reluctant to start a war, still run out of people. The people who are manufacturing the war machines want to start a war. So we used to go back and forth. Does it make it more likely or less likely? And so I think it makes it less likely just because it's so utterly destructive. So I
I
don't
mean,
think,
that sounds like a paradoxical positive
yes.
end to the story, or peaceful end to the story, I should say, particularly with all the polarization that's been in the air and the headline news that has passed of the year of 2024. On that point, Bill, we recently interviewed some cycle practitioners on the FSC TV who were focusing on war cycles, and it's clearly been topical for obvious reason. But just out of interest, there was a question on the determinism of some of these cycle projections. The fact that a cycle projects disruption and potential inevitable event risk. What's your view on how that can play out and where choice potentially exists?
Well, I think individual choice always exists, but then you have crowd psychology. If everybody wants to start a war, they start a war without thinking. And in World War One, at the end of the war, the Germans were yelling at the people, the reinforcements coming up, to not come up because they wanted the war to end. I mean, the spirit just broke. So, we go back and forth like they have people, they have drone operators out in the southwestern United States that are completely protected from any violence. So how do you stop them? You shoot the drone down and another one replaces it.
And recapping back to your cycles, Bill, you also had a view on the decennial pattern, and it seemed well, you mentioned that there were two different signals on the presidential election for one, and then on the other on the decennial. What were the divergences, and how do you square that?
Well, I just keep a close eye on the technical indicators. And somebody asked a question here, what I saw it at the bottom of the screen. What technical indicators do I use? Well, I look at pattern perception, but I also follow the 10-day advanced decline line pretty closely. And I used to follow, there are about half a dozen indicators that have become defunct because the numbers aren't printed anymore. But the best was from the old CBOE, was the number of advancing, declining, and unchanged puts and calls, 6 numbers every week. And they stopped 2 years ago, October, publishing them. And if you ever got to minus 200,000 on, let me get this right now, minus 200,000 advancing calls, that was a buy signal. If you got that 2 or 3 weeks in a row, it was a super buy signal. And in other words, it was like a very, very, very sensitive. It was the people who were doing the early buying and taking a lot of leverage. I looked at it that way. It was setting up before anybody else did. And they stopped publishing them along with a bunch of other numbers. So those numbers were very useful. But I also look at the breadth, but of course they went to decimalization and that has thrown that off. So the old breadth thrust numbers from the past don't work as well now. So people have shifted to volume thrust and price thrust. In other words, if you get X% thrust over 5 days, that's big institutions rushing in. Once they rush in, they're going to hold or add to those positions.
More of an impulse move.
Yeah, and there are a lot of indicators that don't work before 1950. When I was in graduate school, the professor said the institutions will come to dominate this market from this point on because they'll get so big, and he was right. So any indicators based upon the institutions, like I like to monitor, I like to say, November through January, that's when they set up. So if the market is down, that means that they're not they're not buying right now. They're not too optimistic.
We just have some additional questions, Bill, if I can capture them. The one that I spotted at the top. Do you have a cycle chart on the dollar? And either way, what's your view?
Yeah, well, I think the dollar is getting, let's say, January has been the strongest month of the dollar, so I'm pretty sure it's going up. And I'm still bullish on the dollar because I've lived overseas now for 35 years, and everyone overseas, especially in the Middle East, when times get tumultuous, they go to dollar-denominated assets. And as my one of my old friends said, who was running the Abu Dhabi Investment Council, overall, the United States has the best legal system, has the most liquid markets. It is sort of the easiest place to invest. And I know that certain people in the Middle East got burnt by investing in Russia, which I would never do. They also got burnt investing in China, and so on and so forth. So, and also the dollar is the reserve currency. And when I see these ads about the dollar is going to become worthless, well, if it gets dropped as the reserve currency, it might go down very sharply in value because if it's the reserve currency, if you want to transact with another country, you have to convert your currency into dollars first. And so there's an artificial demand for dollar created by the fact that it is the reserve currency. It does not behave like the rand or other currencies.
I think we're getting some comments there from Sahay about on that point. But I think there was a question on. I mean, Sahay was asking about the petrodollar, but Bill's asking, what do you think about the validity of the 80-day and 40-week averages in equities?
I haven't used them, so I can't comment.
And then we had a follow-up question on four-year cycle and commodities. Is that on your radar?
Yeah, well, I think it was covered by Jake yesterday. Yeah, and his commodity work, it shows the basic broad cycles. Yeah, so I think he's right. I think commodity prices are headed higher, and I showed my views on gold and oil, which are really the only. I really don't follow the soft commodities that closely. I did when I was a foods analyst on Wall Street, but not since then.
And now Sergey's also asked a question on the Bradley model, if you had seen its trajectory for the year ahead.
The Bradley model is about as well, I'm trying to think. I already used eating soup with a fork. That's like running up the down escalator. Um, First of all, what price Bradley's book, the Bradley Barometer and how to use it. He doesn't state what data he used. I guess it was a Dow, over what time period he used it, how he had arrived at the valences, the pluses and minuses, whether it made the market go up or down, or the weights. Now, if you handed that in, if you were getting a BS in any college, that would not be accepted. And yet, people for some reason think it's like a holy grail. And I tested it once over 5 years, 60 months, and it was right. I think it was right 48% of the time. So I corrected a lot of the obvious errors and I got it up to 60%, but 60% is the standard mark, and most 60% of all months are up. So the Bradley indicator to me is a very good basic idea. And it was from reading the Bradley book that Arch Crawford got the idea of actually calculating the average percentage changes in price rather than using some number that you cooked up. So the Bradley model was the inspiration. The only person to ever write a book about this was Man and Cosmos by Charles Clifford Matlock. Don't go out and buy the book. And he was a Harvard man who spent his spare time looking at the Jupiter-Saturn cycle and how it affected the economy and stock prices. But he wastes the first half of the book swearing before the Pope that this is not astrology. So he didn't get burnt at the stake. And the second half of the book is about the cycle. And today we can do that at the punch of a button. But that's what led Robert Hand and I to create the Astro Analyst, which led to Market Trader, a financial trader, Market Trader, and today Sergey Tarasov's Timing Solutions. That's the evolution. But the Bradley indicator, I don't pay too much attention to. because it doesn't have any theoretical basis. He doesn't state how he came up with it.
And as a grand finale
Yeah.
question, Bill, you're one of the few people in the team that have attended the Foundation for the Study of Cycle events. You met with the leadership, and you're aware of the heritage that we continue today. What can you say to people here and now that are looking for that conference in June? Are you looking forward to being there? And
Oh, sure.
what
Yeah.
memories
Well,
does it bring back for you?
I got out. I got my MBA in '72, and I met someone. It was probably Arch Crawford. The Society for Investigation of Recurring Events, SIRE, in New York, was an offshoot of the foundation. I went to a dinner, and I found out about the foundation. I immediately became a member and started to read everything from, if you remember the old days, cycles in oats, egg prices. I mean, really obscure stuff, but it was good to read it to see the approach that was used. And I never met Mr. Dewey, but I was very close to Richard Mogi, who ran the foundation in the 90s. And Richard very aggressively, I used to sit down there with him when he was in Pennsylvania and go through, and he used to pull out, for example, the Dow Jones from, is it 1780 or 1880, and explained to me how the prices were derived. And we used to go over the Wheeler War cycle and stuff like, in other words, the integrity of the data. He kept reviewing it. So I am very excited now because people, we have Cycles TV. We have different types of cycles programs. Everybody, it's amazing. Everybody can go to the same, like Donald Mack's Investment Book Center in Los Angeles. I know about half a dozen people who went there to learn from, what was his name? The strange cat. Um, Name escapes me. But everybody came away with a different view of it. Some people were using planetary cycles. Bob Miner was using other cycles. And one very good book, Dynamic Trading by Bob Miner. That is a very good book. And the other book is Trading with DiNapoli Cycles by my old friend Joe DiNapoli. I always trust people who trade for a living because if they're not right, they don't pay the rent. So I'm very excited because we have now computerized it. We have databases. And as our listeners know, the book's by Peter Turchin, who lives here. He's Russian, but he lives here in Vienna. And they have a huge database, but they're taking social events, socioeconomic events, and they're projecting those out. So I think it's, but no matter what you do, no matter how much computer power, you're always going to have differing opinions. Some people are going to look at they announced at some meeting, it's another guy I learned a lot from, Richard Diamond, who was a friend of Bob Proctor's, at a trading course, which I took. He lived on Long Island. They said they're discontinuing this indicator, and he leaps up and he says, "No, no, don't." He says, "Don't discontinue that." They said, "Why, Richard? Is it that good?" He says, "No, it's 100% wrong. It's the greatest contrary indicator on earth." And
Which
so,
is equally important, if not more so.
yeah,
Thank you very much, Bill. It's been great
you're
chatting,
most
and
welcome.
also, most importantly, sharing your insights about the FSC past, present, and of course, future ahead. Look forward to seeing you in person in June.
I look forward to seeing you also.